The Federal Reserve minutes released yesterday signaling that an increase in interest rates could come soon. That coming after what New York Fed President Bill Dudley told Peter Barnes earlier in the week.
I think we're looking for growth in the second half of the year that will be stronger than the first half, so some acceleration in the growth outlook. The labor market continues to generate reasonable job gains. We've 190,000 in the last 3 months. So I think, we're edging closer towards, the point in time where it will be appropriate, I think, to raise interest rates further.
Joining us right now, the Wall Street Journal's chief economics correspondent, John Hilsenrath, with the story in the paper this morning. Fed minutes show split rise possible next month. John, good to see you.
Hey, Maria, thanks for having me.
Just reading your byline, you think we're going to get an interest rate hike soon?
Well, there's three camps. This is what we lay out in our story today. There's three camps at the Fed right now, which is forcing some delay. There are people who aren't ready to move. There are people like Bill Dudley, who you just highlighted, who think we're getting closer. And then there's people who want to move right now. I think it's going to take a couple more good economic reports to get this camp of people who think that we're getting closer into the mode of let's go right now. This jobs report that we're getting in early September, I think, is going to really be a key report.
Yeah, Kevin Kelly, we're in the middle of earnings season. We heard from the retailers, and I guess we did see some strength in retail. So maybe the consumer is out there spending a bit.
It was a mixed bag on retailing, but if you look in the Journal, there's a story about how the service sector and manufacturing company execs are actually, this is from the Fed survey, the Empire State Index, where they're actually going to reduce jobs. A fifth of them are going to reduce because of Obamacare, which is actually pretty interesting. But going back to John's points, basically the Fed's not going to move in September. It's probably a foregone conclusion, and you're seeing the strength in the dollar. It's not around, it's gone down. You're actually seeing the Fed fund future rate showing an indication of maybe 50% in December. So there's a lot of different things. But going back to the economic numbers that you brought up, John, I mean, look at the durable goods, wasn't very good. We're looking at productivity in the jobs, not very good. What I got from Dudley when he said on Tuesday, he said they want to preserve the efficacy of their policies and the tools in the future because they've lost all efficacy now. I mean, if they cut, it's not going to move the economy one way or another.
So what you're saying is the economy is still weak, I guess, John.
I mean, what I'm hearing here is the split that we're seeing between the Fed and the market. The market has become very, very suspicious of, anytime the Fed says, oh, we think we're going to raise rates, the market doesn't believe them anymore. I think that's exactly what you're hearing right now.
John, that's troubling, though. If the communication out of the Fed with the market is flawed because the market just doesn't believe what comes out of their mouth, that's a problem.
Well, it could be a problem if the Fed turns around and says, all right, we're actually raising rates and investors aren't prepared for it. I think that they have, because you've got people like Bill Dudley who are out there who have been saying this for a couple of months now, because they've been saying it, eventually it's going to sink in. And when we see a really, the next jobs report, again, I'll point to it, if we see a 200,000 plus print on that number, I think the market's going to adjust pretty quickly to the idea that the Fed is moving.
I just wanted to say, I'm old enough to remember when Alan Greenspan and the Fed suddenly raised interest rates. I think it was in February of 1994, and you had a complete blow-up in a lot of credit derivatives, and the market just fell apart. That was the year of Orange County. The derivatives collapsed in Orange County.
Well, John, this gets back to the point that a Fed hike may already be priced in, because we got indication last December that they were going to hike 4 times this year, and that's what led to extreme volatility in the marketplace. So it's the expectations and guidance. So they could raise, and then the market may not move or be shocked at all if they give guidance after they raise, that they could raise 2, 3 more times. That's what could set the market off.
Well, I think what you're going to get when the Fed does move rates, whether it's September or December, it really doesn't make that big a difference. Or 17, but I think what you're they think they're going to move again this year. When they do move again this year, I think the message that the market's going to get is that they're not going to be aggressive with the next one or the next one after that. And I think that is going to keep temperatures kind of tamped down this time.
I just want to bring up Obamacare. You hit on it, Kevin, because this is really an important part of the overall economic story for businesses, right? Because it's so expensive. Top story in the Journal, John. Aetna told the Justice Department officials last month it would reduce its presence on the Affordable Care Act exchanges if they sued to block the Humana deal. What's behind this? So in other words, this was all connected, or the government decided to block this deal, and then they said we're not going to participate in Obamacare.
You know,
How bad is this for Obamacare?
I think that it's bad for Obamacare because you have the major providers pulling out of the market, leaving basically consumers with no choice in many places, or with the choice of having to go with very high premiums on their coverage. I don't think that this is necessarily holding back the job market right now because we have an unemployment rate of 4.9%.
Right.
But I think it's a big problem for people out there who are looking for coverage, especially in markets like Arizona where you basically don't have anyone on these exchanges operating.
This is 3 major insurance companies now that have pulled out, Kat.
Yeah, I mean...
Listen, it's a precarious business model where you're capped on your profits and actually you have to lose all this money. There's no one paying into the system, but you have to pay out. So it just doesn't work. It's broken.
This is what they call the death spiral, right? When the problem the insurance companies are having is the only people who are going on and signing up are the ones who really need the coverage, and you don't have healthy people who are signing up and helping to cover the premiums of everybody else.
The health insurers want a higher penalty to make people buy this insurance because the government is not penalizing them enough for the healthy people who need insurance to make it.
Because they're not incentivized.
I don't know anybody who has Obamacare. A lot of my friends, they pay the fee because they go to the doctor maybe once a year.
You're sick, and then you get Obamacare. That's how it was set up.
Well, and the program needs young people signing up.
Yeah, and they're not doing it.
I don't know anybody.
John, thank you. Yeah, they're not doing it. Kat Fish, she knows all millennials.
All of them. I know every single one.
John Hilsenrath, good to see you, my friend. Thank you.